The second quarter has been a period where the Kenyan housing market continued to be fueled by cash purchases, with almost all Kenyan banks hanging on to their big profit gains from higher lending rates. But some small signs of competition emerging from the country's foreign banks, notably Standard Chartered and CFC Stanbic, were both moved to sharply lower mortgage rates on that end. So for more on this, and of course the outlook for property prices, returns you can expect from property relative to the stock market, Sakina Hassanali, Head of Research at Has Consult, joining us from Nairobi. Well, Hasina, thanks so much for joining us today. So let's just get into the overall movement that we have seen in property prices, because overall you're looking at the quarterly upswing there of 2.3%, taking year-to-date change for all properties according to your index to 9.9%. So what that does indicate is a slowdown in quarter two. Is that what we're seeing right now?
Well, no, what we did see was a slowdown in the beginning of the year in anticipation for the elections. What we've seen in the second quarter is actually a slight upswing, and especially in the sales prices of standalone houses, and an upswing in the rental of townhouses.
Mm-hmm. Looking at the movements in those standalone houses, looking at the quarter, 3% gain there, and relative to the year-to-date gain, that's around 10% you're looking at. So where's the movements likely to come for the rest of the year? Are we likely to continue to see standalone houses outperform when it comes to property returns?
Yes, this is mainly because the standalone houses form a big part of the high-end market, and we're seeing the high-end market come back to life. We're also seeing the rents for townhouses increasing because the lending rates are very high, and most buyers are moving into tenancy agreements for their townhouses and opting out of mortgage buys.
Mm-hmm. Looking at those, the letting index for the quarter, you have of course seen a disparity between what apartment returns have seen on the letting front relative to standalone houses. So what do you see this a function of when it comes to the fact that you have seen in fact a pullback in those letting prices for apartments?
Well, yes, this actually has been a welcome surprise to us that the apartments have actually, the rentals have reduced by 0.7% after last year, where we saw between 5 to 7% rises every single quarter. I think what has happened that even with the tax enforcement by the government of landlords' returns and the 30% tax on their profit, while landlords have tried to push up their prices, it hasn't been taken up by the market. A lot of people are opting out of going into apartments and going to rented accommodation that's a bit cheaper.
Mm-hmm. We mentioned the banks there, and it seems that banks are becoming a little bit more competitive when it comes to lowering lending rates, specifically in the mortgage space. CFC Stanbic lowering their rates from 17% that to 13.5%. And then you've also got the likes of Standard Chartered and Barclays who are offering short-term promotions. So of course the cost of mortgages has come down. Does that mean it makes more sense to buy into property right now?
I think those are just the two banks that have come down. The major players, which is Housing Finance and KCB, which take up 50% of the market right now, are still at 16%. If we see them moving down, and if we see all the banks moving towards a single-digit mortgage rate, then we'll really see the uptake of mortgages increase in this market. So. Mm-hmm. In order to see a big difference, we need to get to single-digit mortgage rates, which CFC Stanbic and Standard Chartered are heading toward, but a lot of the banks need to follow suit and do the same.
What is the likelihood that the larger dominant players actually follow suit? Because there are, of course, the cheaper ones in the market. What's the likelihood that at this point in time it makes sense for them to lower borrowing rates?
Well, I think once they buy into the volume market and they come to they understand that there are the volumes out there, and lowering the rate will get them the volumes. I think once they start to experience that, and they will start to come down. And if the government and the CBK and the Monetary Policy Committee continues to put pressure on them, we will see them coming down. Although in the past they have been quicker to take up their rates with CBK rate changes than bring them down. But we're hoping that the actions of the likes of CFC, Stanbic, and Standard Chartered will push them to come down.
I mean, if you just let's just take a step back from the quarters where we've got the numbers just year to date. If you look at the average value of property, it certainly has skyrocketed in Kenya, with sitting at around 7.1 million in December 2000, and now averaging around 24.8 million that at June 2013. So there's been strong gains when it comes to the overall property space. What's the view right now if you had to look at going into the next year, 2 years? Do you think that the market can continue to deliver and continue to outperform the stock market?
Well, yes, because I mean, if historically the property market has been the best performing asset class. It has beat the stocks and shares and all of that. We continue to see that this market isn't a debt market. It is so there's no credit risk. We're not looking. That means that the down cycles are limited. So we continue as much as it's a cash market, we'll continue to see the property market go up, and there's more of the long-term gains in the property market. With the stocks, you do get the short-term gains with the spikes, but property is the best performing asset class over the long term.